I want you to stop whatever you are doing right now and focus, because the message coming directly from the heart of the precious metals world, specifically from Eric Sprott, is not a gentle forecast or a soft prediction. It is a mathematical certainty, delivered with the blunt force of a market veteran who understands physical metal scarcity better than almost anyone alive. The fuse has been lit, and silver, the perpetually undervalued cousin of gold, is facing a guaranteed locked-in move of 30%. And that move is coming, whether up or down. But the critical analysis lies in determining the gravitational pull of that momentum. 30%. That is not background noise in a commodity market. That is a seismic event. This isn't merely about a price fluctuation driven by routine trading volume. This is about a structural vulnerability in the system so profound that a massive move is absolutely unavoidable. Sprott's thesis, which we must dissect and understand immediately, suggests that the current market environment has been stretched to such a brittle point that the only possible release mechanism is a violent snap, a dramatic repricing event that will either send silver soaring into uncharted territory or subject it to a final brutal washout before the inevitable ascent. But I need to be clear. Based on everything we see in the fundamentals, the bias is profoundly and terrifyingly skewed toward the upside. We are not operating in a normal market paradigm anymore. Context is everything. Look around. We have central banks openly debating the efficacy of yield curve control, persistent inflation statistics that the mainstream media tries desperately to frame as transitory, and geopolitical instability that places physical assets, tangible wealth, at a premium not seen since the 1970s. Into this volatile cocktail steps silver, a dual asset that functions simultaneously as a monetary store of value and, perhaps more importantly today, as an indispensable industrial component driving the global energy transition. The problem, the conflict at the very heart of Sprott's claim, is the colossal, staggering divergence between the price displayed on the COMEX screen, the paper price, and the actual physical reality of the metal's availability in the vaults. For years, decades even, the price of silver has been dictated by the relentless, overwhelming short position held predominantly by major commercial banks. These entities flood the market with paper contracts, synthetic ounces, keeping the price suppressed, ensuring supply for industrial users at artificially low rates, and effectively stealing wealth from genuine investors who understand the asset's true scarcity. But every Ponzi scheme, every sustained manipulation, eventually runs into a wall, and that wall, in this case, is the depletion of physical inventory. The open loop we must chase relentlessly is simple. What happens when the physical supply of silver, the registered ounces available for delivery, drops below the level required to satisfy even a fraction of the outstanding paper claims? And why has Eric Sprott, a man who built his fortune on the conviction of physical metal supremacy, deemed a 30% move the minimum required adjustment to rebalance this broken scale? If you are following this structural tension, if the reality of paper promises versus physical metal excites your analytical mind, please take a second right now and smash that like button. It helps get this crucial information out to more people who need to understand the structural risk in the current market. Let's dive into the core development of the crisis, the foundation underpinning Sprott's conviction. The silver market has been operating in a state of chronic, structural deficit for several years now. We are not talking about small, manageable gaps. We are talking about hundreds of millions of ounces being consumed annually, beyond what primary mining operations can supply. This deficit is being filled by drawing down above-ground stockpiles, the hidden inventory held in private hands, in various exchange vaults, and in government reserves. And here is the kicker. The most transparent and visible gauge of this physical depletion, the registered inventory available on the COMEX, is flashing blinding red warning signs. These vaults are emptying at a pace that suggests a desperate scramble for physical metal. Think of the COMEX as the ultimate clearinghouse for industrial and institutional needs. When its registered stocks fall to critically low levels, it signals that the safety buffer has been erased. The shorts, those banks that have sold synthetic silver, are suddenly exposed, standing naked against a market that is demanding the metal they promised but do not possess. The demand side is the accelerator pedal. Silver is not just a shiny metal for investment. It is the most electrically conductive element on Earth, indispensable for modern technology. We are talking about the massive scale-up of solar photovoltaic (PV) installations globally. Each panel requires a significant amount of silver paste. We are talking about the mandatory electrification of the automotive sector. EVs require substantially more silver content than internal combustion engine vehicles, used in countless connectors, switches, and charging components. This industrial demand is inelastic. It cannot simply be wished away or substituted without massive compromises in efficiency and cost. China is buying. India is buying. Industrial manufacturers are locking in supply because they recognize that the spot price is an illusion that cannot last. This combination of chronic undersupply from mines, a geological reality compounded by decades of underinvestment, meeting inelastic, surging industrial demand, has created the perfect tinderbox. Eric Sprott's genius lies in recognizing that the moment this physical shortage becomes irrefutable, the paper market will suffer a catastrophic failure. I want to urge you again, if this deep dive into market structure is giving you the clarity you need to navigate these turbulent times, please subscribe to the channel right now and make sure you hit that notification bell. You need to be aware of how fast this crisis is escalating. The 30% move Sprott refers to is essentially the minimum level required to inflict enough pain on the largest short holders, the commercial banks, to force them to begin covering their positions. This isn't a speculative target. It's a liquidation target. When the paper price must suddenly rise to dissuade physical delivery and encourage enough existing holders to sell their metal back into the market, the move will be swift, vertical, and utterly shocking to anyone not positioned correctly. The banks facing billions in margin calls will have no choice but to participate in the feeding frenzy they themselves created, transforming the suppressed price into a genuine short squeeze. Sprott, through his investment vehicles, has been aggressively buying and removing physical silver from the market for years, acting as a one-man wrecking ball against the paper manipulators. His strategy is predicated on the simple fact that you cannot print physical metal. His positioning is the clearest indicator of which direction he believes this locked 30% move will go. While he hedges by saying, up or down, that is the language of a prudent analyst acknowledging volatility. His actions, his massive accumulation, scream, up. The 30% is merely the first stop on a path toward true price discovery, a path that could eventually lead to triple-digit silver. The ultimate conclusion we draw from Sprott's ominous warning is that silver's price stability is an artifact of manipulation, not a reflection of reality. That stability is about to shatter. The market mechanism that has kept silver tethered is failing due to the exhaustion of physical supply. The pressure accumulating under the surface, driven by industry, monetary debasement, and relentless short selling, must be released. The release will manifest as a minimum 30% vertical move that will liquidate the weak hands and reward those who understand the mathematics of scarcity. We have established the structural inevitability of this massive swing. But what does this mean for your portfolio? How do you position yourself to capitalize on the coming violent ascent? And more importantly, how do you manage the risk of that initial volatility? In the next segment, we will delve into the specific mining stocks and physical vehicles that Eric Sprott himself favors, analyzing the tactical entry points and the potential exit strategies required to maximize returns when the silver rocket finally launches. Make sure that notification bell is rung, because you do not want to miss the deep dive into the actionable strategies that follow. The fundamental premise we must confront, the one Eric Sprott has masterfully locked into the center of the silver debate, is that the market is currently existing in a state of suspended animation, a profound disconnect between the financial instrument and the underlying physical reality. We established in the initial assessment that a 30% movement, be it up or down, is virtually guaranteed by the current supply and demand mechanics, coupled with the extraordinary leverage built into the COMEX paper derivatives market. But the critical question, the one that defines whether we prepare for a catastrophic decline or an explosive generational breakout, rests entirely on where the ultimate pressure point lies. Does the system collapse under its own weight of skepticism, driving the price down, or does the system rupture due to physical exhaustion, forcing the price violently higher? We must begin by dismissing the bearish case, not entirely, but subordinating it to the overwhelming gravitational pull of industrial necessity. The argument for a drastic downward correction fundamentally relies on the belief that global industrial demand, particularly the push toward electrification and sustainable energy infrastructure, will suddenly reverse course. It relies on the premise that investor sentiment will entirely abandon silver as a store of value, flooding the market with existing above-ground stocks, or that a significant new mining discovery will abruptly shift the supply curve. None of these scenarios hold significant weight against the macroeconomic mandates currently driving global policy. The industrial demand floor for silver, fueled by photovoltaics, electric vehicles, and countless other high-tech applications, is not merely resilient, it is mandatory and growing exponentially. Furthermore, the cost of production for miners worldwide suggests that any price sustained significantly below the current trading range forces high-cost operations offline, instantaneously contracting supply and reinforcing the price floor. The market simply cannot afford to have silver fall much further without sacrificing the very energy transition the world is banking on. This realization is the fulcrum point. If the floor is fundamentally locked in place by industrial necessity, then the only direction available for a 30% move of this magnitude is upward. But we are not talking about a gentle climb. We are discussing a parabolic spike triggered by a systemic failure in the paper market infrastructure designed to suppress price discovery. Let's turn our attention to the physical reality that Sprott and his team track with forensic intensity: the dwindling registered inventories in the primary COMEX vaults. For years, the paper market has traded magnitudes larger than the available physical metal, sustained by the assumption that contracts could always be settled in cash or rolled over indefinitely. This system works perfectly until a large-scale entity demands physical delivery, or until the drain on registered stocks becomes so visually apparent that confidence in the paper market evaporates. We are currently witnessing that evaporation. Registered inventories, the silver truly available for immediate delivery to meet contractual obligations, are hitting historical lows relative to outstanding contracts. This isn't just low inventory, this is critical operational vulnerability. Every ounce removed from the registered category represents a tightening of the noose around the necks of the massive institutional short sellers who have leveraged the system to keep prices anchored. If this level of analysis is something you need in your portfolio planning, I urge you to hit that like button and subscribe right now. We delve into these deep market mechanics every week, and you won't want to miss the next one. Sprott's argument pivots on the concept of institutional margin calls and the unavoidable short squeeze. When industrial players who absolutely require silver for their manufacturing processes realize that the paper price is a lie and that the physical metal is becoming scarce, they will stop playing the futures game. They will move directly into the physical market, accepting higher premiums just to secure their supply chain. This is the pattern interrupt we discussed. The moment institutional demand stops respecting the suppressed price. Imagine a large industrial fabricator needing 1 million ounces. They look at the COMEX price, let's say $25. They try to acquire the physical, but the immediate availability requires a substantial premium, pushing the effective acquisition cost to $30 an ounce. As more industrial players join this scramble, the available metal disappears faster, forcing the short sellers into an agonizing dilemma: cover their short position by buying back contracts or face delivery demands they cannot meet. The ultimate irony is that when the short sellers attempt to cover, they must enter the very market they have been successfully suppressing. But because they are forced buyers, operating in a critically illiquid physical market, their buying pressure creates a feedback loop. Every purchase drives the price higher, increasing the required margin on their remaining short positions, forcing more liquidation and accelerating the price rise. This is the definition of a short squeeze, amplified by the low float nature of registered silver. The 30% move is not the ceiling. It is the instantaneous minimum required adjustment to rebalance the paper market with the physical reality. It is the necessary spike to signal to the market that the era of paper dominance over silver is over. Sprott sees this 30% threshold not as an anomaly, but as the unavoidable correction needed simply to keep the lights on for key industrial users and prevent global supply chains from freezing up. But let's not stop at the initial structural adjustment. We need to look far beyond the initial 30%. Once that critical resistance level is broken, once the paper price acknowledges the physical scarcity, the market tends to overshoot wildly. Why? Because the supply side cannot react quickly. Mining new silver takes years, capital investment, permitting, construction. You cannot simply flip a switch and increase the annual supply of mined silver by 20% to meet a sudden surge in demand. This supply inelasticity guarantees that once the upward momentum starts, it will be sustained and amplified by speculator money rushing in to catch the inevitable parabolic move. This is the climax of Sprott's thesis. The silver trade is asymmetrical. The downside risk is limited by the physical cost of production and mandatory industrial demand. The upside potential, however, is explosive, fueled by critical industrial necessity colliding head-on with systemic paper leverage. The move is locked, and the direction is fundamentally dictated by physical exhaustion. Think about the psychological shift. For decades, silver has been seen as gold's volatile little brother, an investment dominated by retail sentiment and prone to boom-bust cycles. However, as the world pivots to the green economy, silver transitions from a speculative asset to a strategic commodity. It is the indispensable bottleneck material for energy independence. This reclassification radically alters its valuation model. We are no longer pricing silver based on inflation expectations alone. We are pricing it based on the strategic criticality of the global technological infrastructure. This transition demands a substantial revaluation, making the initial 30% move merely the opening act. We should view the current price environment as the final window of opportunity to acquire a critical strategic asset at what are, effectively, distressed prices, artificially suppressed by a paper system nearing its expiration date. The conclusion is definitive. The structural forces, industrial demand, finite above-ground stocks, and leveraged short positions have aligned to create an imminent, violent upward break. The current calm is deceptive. It is the calm before the physical shortage completely breaks the financial pricing mechanism. So, what does this demand of the diligent investor? It requires preparedness and possession. Sprott's lesson is clear. If you believe the data on inventory depletion, and if you agree that industrial demand cannot be curtailed, then exposure to silver should be weighted toward the physical metal or trust structures that guarantee backing by allocated physical ounces. This is not the time to be overly reliant on unallocated paper contracts, which may face settlement difficulties when the physical market finally locks up. The time for deliberation is rapidly closing. The move is locked. The pressure is undeniable, and the direction, driven by the inescapable reality of supply and demand for a critical industrial metal, points resolutely upward. This is not about market speculation. This is about market recognition. Recognize the imbalance, possess the asset, and prepare for the inevitable structural revaluation. Don't just listen, act on this data. Share this with anyone who needs to understand the true dynamics of supply versus paper manipulation. To ensure you don't miss our deep dive on Sprott's adjacent gold strategies and other critical macroeconomic analysis next week, make sure you subscribe and turn on notifications immediately. Take control of your financial future by understanding the physical realities that dictate true wealth.